Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. Today is June 2nd, 2026. And before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And my guests today are Don Casturo, founding partner and chief investment officer at Quantix Commodities, and Kristof Gleich, president and chief investment officer at Harbor Capital. Very excited to dive into gold, silver, copper, the broader macro themes they're seeing emerging in markets today. We're going to skip the intro and get right into it. And I want to start by discussing gold, because last time I had you both on the show, the metal was at around $4,300. We had a nice run to new all-time highs, of course, of around $5,400 in January of this year, and a moderate correction with gold chopping mostly sideways since March, now sitting around 4,500. I'll start with you, Don. What do you make of gold's recent price action? And do you think the peak of this bull market is over, or does gold have more room to run here?
I think longer term, gold definitely has some more room to run, given the structural buying that brought gold to the record highs that we saw earlier this year. I mean, it has run into a bit of a notable headwind in terms of a reappreciating dollar and rising rates, which is always a tough environment to get retail participation in the gold sector. But why I think longer term it still has a room to run is that even when we had higher rates earlier in this decade, gold was still performing from a sizable bid from central banks that were in the process of de-dollarizing, and I think that's on the back of institutional credibility concerns. I think with the U.S. as a reliable trading partner, and I don't think that has changed at all with what's gone on in the Middle East. It's just rates have made retail participation harder, but the demand for central banks have been resilient, and I expect that to continue as we maybe move through the rate cycle.
I'd agree largely with that. I'd argue actually gold's been pretty resilient in terms of, yes, it's been on a bit of a ride, but it's been pretty resilient in terms of, if you think where we were. So we were last on the show December 15th, 25. So what is that, sort of 6-ish months ago? I think gold's going through a period of consolidation. Vis-a-vis 6 months ago, we were probably expecting 3 rate cuts by the Fed by sort of probably nowish, and we've had none. And in fact, the markets are pricing in a Fed hike. And despite that, I think, gold has held in there pretty well. We've obviously had a big shock, a supply shock in the energy markets that I'm sure we'll talk about. And if you think about the types of inflation, we've gone from a debasement regime where we were solidly in, to now a more balanced regime of scarcity and debasement again. So I still think the longer term drivers for gold of debasement, deglobalization, all the Ds that we mentioned last time are still very much intact. And once we get through this phase over the next few months, I think we'll resume a more positive environment for it.
Great thoughts from both of you. I want to move on to silver, but before I do, really quickly, there's been some breaking news today. Gold now surpassing U.S. Treasuries as the largest reserve asset globally. I believe the ECB reported this, as well as several media outlets. Don, I'm wondering if you have any thoughts there, because it wasn't that long ago that gold surpassed the euro, and now we're surpassing U.S. Treasury bills. Is this a new monetary paradigm emerging?
No, this goes exactly to my point of questioning institutional credibility of the dollar and a desire to de-dollarize. You're seeing it in reserve asset data that you just alluded to, and I expect that to continue.
Well, let's talk about silver. Or go ahead, Kristof. Yes.
Yeah, no, I was just going to say, and I think if you ask the question with another question, like a rhetorical question, what plausibly would have to happen from here for treasuries to re-overtake gold as the number one reserve asset? I don't see a plausible political macro kind of environment happening in the next few years. That's very likely to cause that.
Well, let's talk about silver, because it has closely followed gold's price movements, of course, with bigger swings and greater volatility, coming off a high of over 100. We got to 116, I believe, on the close on one day, which many people didn't think would be possible. I'll tell you, on this show, I have a lot of people discussing silver, and when people were talking about triple-digit silver, the comments were filled with naysayers, yet we made it there. We've now come down the other end, sitting at around $75 today. Is there another leg up in the silver bull market, Don? And if so, what are the catalysts that could potentially take us back to triple digits?
It was the same catalyst that took us there to begin with, even though there were naysayers. It's just if the herd wants to buy silver, it's gonna move because it's a very small market. I mean, globally, only 98 billion per year of production, 38 billion in total open interest on the CME silver contract. You compare that to single companies with trillion-dollar market caps. If people get excited about silver and rush to buy it, you could see some big numbers like we saw in January, but it's going to take that sort of recommitment to want to own it to get it there again. I think it's possible because again, a lot of money flowing into a small market, you can see some big moves.
We have to discuss energy markets. Kristof, you alluded to it. Of course, the war in Iran sent WTI crude to over $100, with it still remaining fairly elevated. I believe today we're at around $93 and change. Of course, we're seeing these on-again, off-again negotiations and attacks. And of course, we all hope this conflict's come to a close as soon as possible. But how do you see energy positioned right now? I'll start with you on this one, Kristof. Do you think investors should have exposure to energy at this point if they don't have any? Or would you be cautious given how closely prices seem to be tied to the war and even to tweets coming out of the president's office?
No, I think as part of a diversified portfolio, we would advocate very strongly for a diversified commodities solution as part of that diversified portfolio, which energy is a key component. Yes, on any given day, it can be volatile and very reactive to the headlines, but the facts remain. The Strait of Hormuz is firmly shut. There are a handful of ships. There has been a historical drawdown in energy, in reserves that will have to be replenished. And so I do think, I'd be interested to hear what Don's going to say on this. But, cyclically and secularly, I think there's a pretty good argument to be made for energy right now, whatever headline may be generated by the end of this interview.
Well, Don, is the risk here that should peace occur, should the strait be reopened, that we could then see oil prices plummet back down to where they were pre-conflict in the 60 some odd dollars range for a barrel of WTI crude? Or are we now in a new world where perhaps the floor price on WTI is going to remain elevated regardless of what happens with the conflict?
Yeah, I would strongly argue we're in a new world where the floor is much higher elevated than the $60 we saw earlier in this year. And it principally comes down to what Kristof already mentioned, how much actual supply has already been lost due to this conflict. Already estimates of over 1 billion barrels of supply have been lost. And depending on the scenario for when we might see some normalization, I'm sort of pessimistic on that, could be up to as much as 2 billion barrels of actual supply lost throughout this contract. Now, how have prices not exploded even further than this already, given that scenario? Mostly because massive destocking. The Chinese were, we may even have talked about this on our last thing, our last episode, were accumulating strategic reserve inventories, which kept oil prices in the 60s when people were saying with this much oversupply, we should be even lower. They were smart enough, fortunate enough to be accumulating strategic reserves, which they have now largely drawn down. At the same time, record SPR releases in Western nations have helped kept prices in check to offset this 1 billion to 2 billion barrels worth of supply loss. But I'm very confident those reserves are going to be restocked and then some, going back to the deglobalization, security of supply issues that have come up as a result of this conflict. Every nation is not going to want to find themselves exposed to continued weaponization of supply chains, and are going to try to ensure themselves by building up reserves again, including the Western nations and China that I just mentioned, that I think keeps a floor under oil prices, regardless of the headlines that we see come out. One other thing I would say about why you need to have petroleum or energy more broadly, but petroleum type of investments in your portfolio. The forward curve is so backwardated. The expectation that prices are coming down is so priced in the futures curve of petroleum and petroleum products that there's currently a 44% annual positive roll yield to owning the petroleum sector in our QCI index. Even if a headline was to drop oil by 10%, you're still facing an annualized 44% loss if you continue to roll a short for the next year if the curve stays in the same shape, which I expected.
I'll just add to that, and leadership in the world has seen firsthand in the last few months the value of having strategic reserves, and therefore they are going to be very much likely and inclined to rebuild those strategic reserves as quickly as possible, because the threat of rolling supply shortages is real. Like we've lived it. We're still living it. And the Iranians to a certain degree have the world over a barrel, pun intended, with how they're controlling the straits at the moment. And I think governments are going to want to insulate themselves from this happening again. And you could have a series of rolling strait closures as some form of kind of geopolitical negotiation in the future. So they're going to get rebuilt pretty strongly.
Let's talk about copper hitting new all-time highs today, currently around $6.70 a pound. Don, what are your thoughts here on the copper market? What are the catalysts driving the metal, and how do you see it performing moving forward?
Another bull story when you talk about copper, and it's supported from both the supply and demand perspective. I think people, if they're worried about buying copper at all-time highs, it comes down to the demand side, which has actually been fairly resilient. And I think you can attribute that mostly to AI and power generation and the key role that copper plays in the power sector, being such a good conductor that there will be high demand from well-capitalized entities to keep demand high, even if we're seeing all-time high prices. But a part that's often overlooked when they're worried about buying copper at all-time highs is just how dire the supply side story is in copper. We lost 1.5 million tons of production last year between outages in mines like Grasberg and Cobre Panama, which are extending into 2026. And if you couple that with a resilient demand structure, with that significant up 6 to 8% of lost mine supply, that justifies higher prices.
Well, let's dive into some of the strategies you both employ at Quantix and Harbor Capital. Don, you mentioned AI. I want to start with that and how it's connected to commodities markets, because you wrote in a recent article, as Quantix has begun to evaluate the integration of AI into their operational workflows, the team has become even more bullish about the commodity demand implications. Asking AI to do ever more seems inevitable. So walk us through the commodity demand you see being driven by AI. You mentioned you think copper is a piece of that. What else are you seeing there? And then I'd love to get both of your strategies around that theme.
Yeah, I mean, we've just started to utilize AI here in our workflow at Quantix, and what I realized through that process is that AI adoption is still very much in its infancy, which is just awe-inspiring when you think about the potential energy consumption if it starts to get used at scale. And this isn't like an iPhone that, like, once you buy it once, you don't really need to use any more of it. Even iPhone 16 isn't that much different than iPhone 4. Like, you could still be using that. AI is something that when you use it for simple applications, your mind starts working about how many more exciting, more complicated applitions I could use it for, which are going to be just incrementally and exponentially more energy intensive. And I'm very much onto that theme in terms of how it might impact our business going forward. Initially, I thought there would be a lot of opportunity in power trading. I'm now starting to think the bigger impact might be both upstream and downstream from actual power, as you're seeing regulatory pressure for a lot of these data center guys to create their own power and get off the grid. So that'll just push the real impact down to energy supply resources like nat gas or nuclear, things that can create consistent round-the-clock supply. Like, alternative energy isn't as applicable there because solar and wind obviously have intermittent supply concerns that nuclear and gas can still address, or potentially even going downstream, where tokens and the actual use of the AI power, where you're talking about tokens being created to do AI searches. I can very much see that becoming a tradable instrument, and we're looking into the prospects for that going forward. Just imagine if AI is replacing labor, if there were ever a derivative where you could trade labor supply. Like, that never existed because that was too hard to get your head around trading people. But if it's a machine doing the work and a token can represent that labor unit, I think that's going to be an exciting tradable market going forward.
Yeah, fascinating implications. Kristof, how are you wrapping your head around the AI theme in markets today?
Yeah, I mean, look, it's all moving in sort of warp speed at the moment. So I'd say just directly for commodities, I thought it was interesting. The CME announced a few weeks ago that they were going to be creating futures on compute, and so within a few months from now, the CME are going to have a partnership with NVIDIA where there'll be futures curves for compute for the H100, H200, and the Blackwell chips. And just sort of think of this one example of the innovation of sort of financial markets to innovate around this innovation, this amazing new technology that's happening that's going to create new opportunities for investors and industrial firms and tech firms to help hedge themselves out. But look, I think from like a sort of a business perspective, I think we're at this sort of Cambrian explosion moment of AI, and it really is just beginning. And I like to sort of think that we are in the Ask Jeeves era of the internet. And if you'll remember that, sort of back in 97, 98, the internet was this kind of search engine. It was even kind of predated Google. And our view of the internet was it was this efficient search engine, and it would help you retrieve information or different documents. It would help you send messages quicker than sending a fax or a letter. And the sort of our frame of reference was how it would help us do things that we already knew how to do, but do them more efficiently. But that's just laughable now when you look back at what the internet became, and it spawned and created entire new industries and businesses and trillion-dollar companies, built on top of the rails of the internet back then. But it was impossible to tell exactly how it would play out back then. And I think we're at a similar moment with AI. And the Ask Jeeves of today are LLMs and these chatbots that are amazing. And most people that use AI today, I use ChatGPT, and it's like, oh, okay. And I think this year we're transitioning from the LLM and chatbot era to much more like agentic AI. And so at Harbour now, we are spending a lot more time training our employees on how to build agents that actually operationalize workflows, create huge efficiencies. And if I speak to a quant researcher here at Harbour, they are 20 to 30 times more effective and more powerful than they were 2 years ago. They're at like the bleeding edge of AI. And so I think all of our kind of associates, employees are going to be coming up that curve, and it's just going to open up sort of incredible opportunities. And look, I think Larry Fink said it pretty well a couple of weeks ago. He said AI is not a bubble, it's a new asset class.
Well, Kristof, I want to stick to you and dive into the investment thesis you operate from at Harbour Capital. I want to read a quote from Financial Services Review. It says, Harbour expects the global investment environment to become more structurally complex in the coming years. Shifting macroeconomic regimes, evolving market dynamics, and changing portfolio construction frameworks are likely to reshape how investors allocate capital. Can you break down in a bit more detail for us why you think complexity in the overall investment environment is ramping up? Are we entering an era where the 60-40 portfolio is dying? Are we entering an era where passive investing into the S&P 500 index fund, is that going to be going away in your view?
Yeah, look, I think the 60-40 is very, very challenged. I think saying the 60-40 is dead is a little bit reminds me of JGBs in the 90s, the Widowmaker. And betting against lower rates, and they kept on going lower and lower. But that said, the 60/40 post the financial crisis all the way through to say COVID in 2020 was the gift that kept on giving. We had a period of almost 15 years where a passive set it and forget it 60/40 portfolio delivered 10% nominal returns. Inflation averaged about 1.8, 1.9% over that period. So you had a real rate of return from just passively investing of just over 8% per year. That's an amazing environment, but that was the anomaly. And I think because it was around for so long, we got used to that being the normal. So I think the new normal is one where inflation is higher. We talked about some of the drivers today. I think we're in an environment where interest rates are structurally higher. This isn't some cyclical high in rates. We are in a structurally different interest rate environment than we were in the 2010s. And I think AI is a driver a lot of this. If you think about the period of the 2010s, we lived in a world of excess savings. When you live in a world of excess savings and a lack of investment, interest rates, the real rate is going to go down because there's not much demand to use those savings to invest into productive goods. The era that we're in now is there is a boom in investments like we have never seen before. And when there is such a surge in demand for investments, all else being equal, it's going to push up the price of capital, aka the real interest rate. And I think that's what we're living through still. And obviously the debt situation, the deficit situation, all the things that we sort of spoke about, deglobalization, that is still all in the background. But I think this AI boom is accelerating even quicker than we thought compared to sort of 6 months ago. So diversification, commodities, clearly, we spoke a lot about this last time. We advocate roughly, again, every client needs to do their own homework. Every client and investor has their own individual unique facts and circumstances. But as a broad-based proxy, if you're talking 60/40, we think probably a 60/30/10, with the 10 being in commodities, is all else equal, a better portfolio. And then I think there's going to be continued innovation. We spoke about AI, the different ways of slicing and dicing and accessing the AI theme is going to continue to expand and evolve. And I think that's something that investors need to keep a keen eye on as well.
And Don, do you have any thoughts in terms of the increasing complexity of markets that Kristof mentioned?
Yeah, I mean, I think it's the structural shift that he's alluding to that I think investors need to be paying attention to. We're in structurally a different environment than where globalization was leading to global efficiencies, and the 60/40 portfolio with real yields being as high as they were imply a different set of ideal investment characteristics than the new world that we're in. So I would echo his comments there.
Well, let's talk about Harbor Capital's portfolio of ETF products, because last time we discussed HGER, the commodity all-weather strategy, which is actually up over 27% since the last time we spoke. Kristof, could you explain why this is a strategy that you think will continue to perform up ahead, and maybe dive into the details of what's under the hood of that ETF?
Sure. Yeah, I'll let Don. He tells the story better in terms of diving under the hood. But I'll say this: a well-constructed, diversified commodities portfolio has, in my opinion, never been more valuable than it is today to help investors navigate this environment. Like you said, since we were last on, we're up about 29%, which is a little bit higher than kind of broad-based commodities indices. Compared to bonds are up a whole 0.75% in total return space. So outperform that, and equities are up double digits. So commodities really proving their worth. And to the point of diversification, that we spoke a lot about gold last time, and gold has been by no measures the best performing commodity since we were on this show. But our diversified commodities portfolio, HGER, we call it hedger, as in a hedge to your portfolio, has done very, very well because it's diversified, because we look at the commodities regime across scarcity and debasement, and we try and have a diversified portfolio that can compete in either one of those environments. But I'll pass over to Don.
Yeah, so Hedger tracks the Quantix commodity index, and as Kristof was saying, the genesis for creating that index was recognizing that the traditional commodity benchmarks, originally the GSCI and later the Bloomberg Commodity Index, were not created with a specific investment objective in mind, which investors are largely using to diversify their portfolio and get inflation protection. So we reimagined what that basket should look like if that was your investment objective, and made a couple of key distinctions, like allowing for a dynamic reweighting to identify whether inflation was more likely to be driven by debasement or scarcity, and rebalancing the basket accordingly. And because we've done that, it's able to perform in environments where gold is rallying, and also environments where refined products are rallying on the back of a supply shock, because it's dynamically reweighting to capture either potential source, and also very much attentive to roll yield and how that can affect longer term returns of investment in commodities. And the QCI methodology does a better job of that than the traditional benchmarks. So in this era that we've identified as being important for commodities, equally important is picking the right instrument to express that view. And I really believe that Hedger tracking QCI is exactly that.
Well, Don, Quantix offers two funds when it comes to commodities: Quantix Active Inflation and Quantix Commodities Alpha. Could you walk us through how those products are put together, and also how investors can access them? Obviously, the Harbor ETFs, you can just order them through your broker. How do these funds work in that sense?
So the Quantix Active Inflation is essentially just a more active implementation of the framework that the QCI, Quantix Commodity Index, that Hedger tracks. QAI is just a more active implementation of that same framework. We start with QCI as a baseline, and then put discretionary active views to overweight and underweight certain sectors more frequently on top of that. And investors can allocate that through commingled funds or separately managed accounts. Contact us. We're very flexible in terms of vehicle implementations. And then the Quantix Commodities Alpha is a more pure absolute return discretionary hedge fund type model, where we employ our commodity expertise to try to harvest persistent dislocations that are caused by inefficient access to the asset class, coming from somewhat predictable hedging activity or the way long-only indices access the markets, and we're trying to extract alpha in that regard. We also have offered that in a fund and separately managed account format. Currently closed to additional capital as we try to expand capacity, but and that has been active and running for 8 years now.
Well, I'm going to end by opening the floor to both of you. Is there anything we haven't yet touched on, or anything you think it's important to emphasize on Harbor Capital and Quantix Commodities investment strategy that you think investors should be focused on? Kristof, I'll start with you.
Yeah, look, I'd just say, be vigilant, be invested, but, be thoughtful in terms of sort of diversification. We're living through an extraordinary environment at the moment. On one hand, we have an absolute CapEx boom driving AI. We're at the early stages of this transformative technology. We're trying to get our heads around, how it works, what the implications are for it. And we're also, it seems, sleepwalking into an energy crisis on one hand as well. So the world is very different today than it was, a few years ago, 10 years ago. And I think the way investors need to be positioned needs to evolve as the world changes before us.
Don.
Yeah, I'll just say then, and because I see this every day, and we're trading the commodity markets, that the obsession seems to be on headlines and what's going on in the Middle East and the Straits of Hormuz. But everything we talked about on today's call is more structural and longer term than that. And I would try to emphasize to your listeners, think about the medium to long term and just how bullish structurally that is for commodities, and try to separate yourselves from the headline news that can be very frustrating, but not part of the longer term picture anyway.
Amazing thoughts from both of you today. Greatly appreciate your time. I'm going to be putting links to Quantix Commodities as well as Harbor Capital websites in the description below so people can check out your products there. Gentlemen, great conversation. Thank you for coming on.
Thank you, Jesse.
Thanks, Jesse.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.